You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. The Advisor's Option is also brought to you by Northern Trust Capital Markets, offering a unique blend of transparent trading, quality execution, and smart liquidity solutions across institutional brokerage, transition management, securities lending, and foreign exchange. Northern Trust's options offering includes quiet access to non-traditional pockets of liquidity, with hands-on support from experienced traders to customize your trading strategy, combined with the peace of mind that comes with trading through a stable and globally respected firm. To learn more, contact John Cherry at John_Cherry, spelled like the fruit, at ntrs.com, or visit northerntrust.com/capital markets. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program here on the old Options Insider Radio Network, where we go deep into the world of options for you, the busy asset manager and financial advisor. Maybe you're looking to explore the world of options on behalf of your clients. Maybe you're already there. You just need a little guidance. Either way, we've got you covered here on the Advisor's Option. My name is Mark Longo from the aforementioned network, and I'm pleased to be joined on this final show of 2018, getting ahead of myself, 2018 here for the Advisor's Option. A lot to talk about here. It's been a crazy, wild, rock'em sock'em year. Not quite over yet, but we're still going to look in the rearview mirror a little bit today. Helping me do just that, let's go around the horn. Let's spin the old Advisor's Option wheel where it lands first all the way up in the Northeast, where we are joined by Mr. Matt Amberson, the principal and founder over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome back to the Advisor's Option, sir.
Thank you, Mark. Excited for the end-of-year special here.
End-of-year palooza, if you will, sir. Now we're going to spin that dial all the way down out into the cold, cold, frigid Atlantic. But he's not cold. He's actually in a little tropical spot. He's in scenic and sunny Puerto Rico, where we are joined by Mr. Chris Hausman. He's the portfolio manager, also known as the manager of risk over there at Swan Global Investments. Mr. Hausman, welcome back to you, sir, as the clock winds down for 2018. How are things in the land of Swan Global Investments?
Doing well as always, Mark. Good to be back on. Thank you very much once again.
Got to have the director of risk, otherwise it just wouldn't be a show. Who would direct us here in our risky needs here on the program? All right, and spinning that wheel around again. He was going to join us here in studio in Chicago, but alas, he was called away elsewhere. But he's beaming to us from that other option/market mecca known as New York, where we are joined by Mr. John Cherry, the global head of options over there at Northern Trust Capital Markets. John, welcome back to the program. We'll get you in the studio one of these days, sir.
Hey, Mark. Happy to be here and indeed talking to you from beautiful New York.
Beautiful New York. This time of year actually is nice there. Got a little bit of white on the ground. Got the trees up, all sorts of fun stuff. The windows are up on the street. Got a little bit of festive holiday cheer going on in the city, which is New York not known for its cheer all year round, but this time of year kind of does. All right, so speaking of this time of year, it is that time of year, listeners, where we're going to kind of start off looking back a little bit, looking back in the rearview mirror. It has been a turbulent year, just from just about any perspective, particularly from a market's perspective. You know, there was seemingly one consensus when President Trump was elected and took office in late 2016, and of course took office in early 2017. There was one unanimous consensus across all of our programs on our network, across all of our contributors, across all of our guests. We could boil it down to one quip, one phrase, which was effectively Trump won't be a single-digit VIX president. And then, of course, lo and behold, we had all of 2017, which he pretty much turned out to be exactly that. In fact, he drove the markets to new all-time highs and drove volatility to new near-term lows. And it surprised a lot of people because everyone pretty much expected a lot of turbulence, a lot of volatility as a result of his administration. Fast forward to 2018, and that's pretty much what we got. You know, the year kind of kicked off with a lot of things, a lot of it not of his doing, actually, in the beginning of the year with, of course, February. When February hit, the VIX-ocalypse, Feb-ocalypse, call it what you will, a very tumultuous period in the moment. That was the moment where we really broke out of that regime of VIX hovering around the single digits. All of a sudden, we saw volatility exploding back into the marketplace, very devastatingly in some fashion, particularly for a lot of people who were invested in the inverse side of the volatility space, because that was an area that was left just strewn with wreckage mortgage and still really hasn't recovered. We're going to talk about numbers in a little bit, and we're going to see that the volatility side, particularly the futures, has still not recovered from February. It's kind of been a wasteland ever since. But that, of course, set us on this trajectory for higher volatility, getting volatility, aka the VIX, back into the teens and then into the mid to low 20s, where we're kind of hovering right about now. Then, of course, throughout the year, we saw repeated injections of volatility through things like the Fed, through things like the ongoing specter, and then in the start of the trade war. So a lot of things have continued. Now we have the looming specter, potential shutdown in the market. So DC has done its job, done its due diligence really to inject some volatility back into the marketplace. So it has been an interesting year from an options and from a volatility perspective. I want to take the opportunity, as we always do here on the Advisors Option at the end of the year, to kind of look back. Let's go back around the horn the other way. Let's start in New York. John, let's start with you. This has obviously been a big year for Northern Trust, really kind of planting their flag out there in the options space this year. What are kind of some of your takeaways looking back at 2019? What really resonated with you from an options perspective, from a volatility perspective, and maybe from a client perspective? What have you really heard from the clients in 2019, and what was some of their feedback that really resonated with them?
That's you hit on kind of the main points that I would echo, but to kind of hone in on one in particular is that the information that you get kind of at the speed coming out of Washington, whether it be on via social media and Twitter, and just kind of how the market gyrations have continued based on some kind of simple facts that can kind of, or even rumors that get sent out of Washington, can really kind of affect volatility in this new vol regime. And so a lot of our kind of more active clients, i.e., hedge funds and other investment managers are taking advantages of those kind of outsized volatility opportunities and looking to put some money to work.
So you'd say your clients then are not so much dismayed by this return of volatility, but actually see it as an opportunity then?
That's exactly right.
And that's always an interesting prospect, because a little bit of volatility, a good thing for the markets, clearly a good thing for the options land. Too much of a good thing, though, is never a good thing. And we flirted with that a few times, particularly in February. Not quite there now anymore, but there is that level where I call it the take your ball and go home level, where everyone's kind of watching out for that. Not quite there these days, but it's always lurking on the horizon whenever you have some vol back in the space. Going back to the director of risk, it's his job to direct things like this. Chris, we've seen a lot of risk on the table this year. What are some of your thoughts, some of your key takeaways from an options and volatility perspective here as we look back on 2019?
Well, I'm going to say that 2018 was the year of the volatility sandwich.
I keep saying 2019. I mean 2018, of course.
That's okay.
I'm way ahead of everybody here.
I'll forgive you this time. So anyways, January, we set all-time highs in the marketplace, and volatility was actually firm. And I think that was a first for a lot of people to realize that, wait a minute, you mean volatility doesn't go down every single time markets rally? And then we had the February event, which I'm not going to hash out again, which has been talked about over and over again. But then quarter 2 and quarter 3 were actually pretty stable as far as harvesting risk premia. So there was a good clawback period. Q1 was challenging for that kind of trade. Q2 and Q3 was very profitable. But then all of a sudden Q4 rolled around with October. November was pretty whippy, and now we're going through December. So it was really within 12 months, you had 4 distinct periods with respect to volatility trading. And that made it kind of challenging for the whole year for anyone who was involved in any type of short premium strategies.
And same thing for you. You guys are obviously out there doing a lot of outreach with the 10th box events as well, educating this exact audience, the advisor asset manager audience. What has kind of been your kind of anecdotal takeaway from talking to them? Are they like John's clients? Are they excited by the opportunities poised by this? Or are they maybe a little bit spooked, or maybe somewhere in the middle? What's kind of your consensus from hearing from them?
Well, it's pretty much in the middle. I think one of the questions that we get a lot of, our market's changing around us. And it's kind of like, well, what John just said. I mean, the speed of information, the algos keying in on every single word from the Fed, and we're going to see what happens tomorrow. And they have to be very careful on their wording now and what they put together, because they know they're going to move markets. I mean, basically, it's almost the rise of the machines where volatility's back. These are periods that, all of us who've been in this business for many, many years, we kind of have to dust off our experience or the, hey, remember back in 2011 or what have you year. It's kind of repeating in a way. It's not the same, but it's similar. And I think that's kind of where, the experience and being able to handle risk and just, having the ability to say, hey, this trade just isn't working in this environment. why don't we sit on the sidelines and wait until, that expected value or the risk reward comes back into our favor? Because at the end of the game, everything we do here with options, all of us on this call at the end of the day is we're trying to maximize some probability and then maximize some payout. And if it's not setting up for you, then, it's okay to sit on the sidelines for a little bit and make sure that, conditions get back towards, or back into your favor.
This is definitely a market environment where a little bit of experience does go a long way. If this is your first cycle of seeing some return to a normal level of volatility and things like that, it could be a little turbulent, it could be a little scary. And certainly if you're an asset manager and advisor out there attempting to guide your clients through this period and you haven't really seen it yourself, it could also be a little bit intimidating. So these are definitely times when maybe you want to turn to an experienced hand to help you guide the tiller there. Matt, you're obviously interacting with a lot of different aspects of the space over there at ORATS. People, advisors and asset managers coming to you for outlook, for indicators, for your models, for strategy back tests, for a variety of other things. You're also now a registered RIA yourself over there at ORATS. So what are some of your takeaways from 2019? So looking back at volatility and all that, and then we'll get into the earnings in a bit, because I know that's a very special area of interest for you guys.
Yeah, I was looking back at our notes from last year at this time, Mark, and we were talking about Bitcoin, and I think I had the quote, it was feeling toppy at 14,000. What the heck is
Bitcoin? I don't know what you're talking about, sir. What is this Bitcoin thing you're talking about?
Yeah, I know. And, the vol was very low, and I think I lost the bet to Chris, so I have to go down to Puerto Rico and take him out to dinner in January. So, so I got one. I'm 1 for 1. Or 1 and 2.
Well, if you need to make a connection in Chicago for an additional steak dinner, we're always available. Just putting it out there as a generous folks that we are here.
Yeah, so our indicators going into last year looked very good, and then they turned. Luckily, the very beginning, end of January, when it really started getting ugly. Our indicators turned in October for I like Chris's volatility sandwich. So. We got the peanut butter on both sides of the peanut butter and jelly sandwich there. So we had it started looking ugly in October, and our numbers still don't look very good. So I'm still pretty bullish on volatility, but I think there's still a lot of room for movement and volatility here going into January and the new year with the yield curve and the government losing trillions of dollars and not knowing where, I think everything coming out of Washington right now just looks kind of shaky for the markets. So, what we're doing, we're continuing to, look at volatility regimes, back test using those volatility regimes, change, we're getting a little bit less risk on right now for a lot of the clients. And that's how things are looking right now, Mark.
And of course, you guys do a special bit of analysis over there at ORATS, which has proven to be very popular again in 2018. I'd imagine it will be again next year as well, which is, of course, crunching the numbers on the somewhat scary, somewhat crazy world of trading options around earnings. People always ask about that every earnings season, every earnings cycle. How should I look at it? Should I go short premium? Should I go long premium? Is there some sort of special strategy that's the silver bullet for trading around earnings? And of course, there was a dearth of analysis of that, dearth of crunching the numbers, until you guys came along over there at ORATS, and you guys have been crunching the numbers. You can find all that, of course, at theoptionsinsider.com. Earnings, move reports, what the market is predicting, what the market's pricing in, how these moves actually play out in the marketplace, and how that compares to the predictions, previous quarters, past calendar years. You guys crunch a lot of numbers for people, and you give it to them for free. It's really, really a generous thing. Of course, you can go head on over to orats.com, ORATS.com. Check out the blog, and of course, if you want more of the premium analysis they do over there, I encourage you to check that out as well. But Matt, you guys have been crunching the numbers for thousands of underlyings now throughout the course of 2018. It's kind of been a weird year on the earnings front. I'm curious for you what really stood out. We had some years we have that crazy blowout, knock the doors out quarter, and then quiet times. Had a little bit of that this year, but what kind of really resonated for you? Maybe some takeaways, some lessons from the earnings, options, and volatility front.
Yeah, the first 3 quarters were normal from that perspective. We usually see 60% winners if you're selling volatility and 40% winners if you're buying volatility. However, in this last quarter that we just went through, it was a lot better for the buyers of volatility, buyers of straddles, and which was odd because it was so expensive, meaning the volatility was high in the market, and that drove up the volatility of the straddles around earnings. So if you had kind of traditional signals, it would look like, wow, these are very overvalued straddles during earnings, but we have ways to take out volatility and from earnings and then compare those. So we had a pretty good month for our premium service clients. Did decently on the buying and selling. We were able to eke out a little bit. But it was something where you really had to dig deep, and you couldn't look at the past straddles, for example, and the past projections because the market was so different. So, for the first three, it was pretty standard fare, but this last one was one of the most interesting quarters I've seen in a few years. So, that in a nutshell, that's how I'd kind of sum up the year from an earnings perspective, Mark.
And we always kind of reiterate this. I think it's worth reiterating again here as we're talking about earnings, options trading. People always ask us, what is the approach? What is the silver bullet? Should I sell it all? Should I buy it all? Is it the 1/3/2 ratio iron condor swap? What's the silver bullet? We really haven't found one, but Matt, I know you say the data kind of breaks down. Let's just reiterate that for people again. Maybe since last time I talked to you, maybe you have found the silver bullet, in which case don't say it on the show, just type it to me in the chat. But I'm curious, what are your thoughts, people who obviously have that question all the time, who want to know the silver bullet for earnings options trading, sir?
Yeah, we take a basic, easy approach. You just got to look at buying straddles or selling straddles, but buying the wing. So doing an iron butterfly is kind of just you're making a call based on an earnings. Don't get too fancy. And so that's what we measure. That's what we back test. And it's all about finding what works for each individual. We look at dozens of signals, and we've identified the ones that we think are the most important. Including things like where's the historical volatility versus the implied volatility going into earnings, taking out the earnings effect. So it's really important to be able to take out that earnings effect. Because, if you look at any stock like Apple, it'll just kind of, the implied volatility will drift up as you get towards earnings and then fall down, and then drift up towards earnings and fall down. And people will say to me, well, it looks like you just, you buy implied volatility and then you sell it right before earnings. Obviously it doesn't really work that way because you're seeing the decay as well. So you have to back test these strategies using, very sophisticated means to do that, and then come up with strategies that are yours, that are something that's not obvious out there. And then those are ones that you could then start to pivot on and think, okay, so now I'm going to test these. How did they work? And then manage your risk. And that's the big thing, really. Find a strategy that's yours. Watch your risk, and really, take notes or have a spreadsheet of how you're doing and how you've done. And it's just a disciplined approach to trading, and that's how you see people year in and year out. And those are the people that make it, the ones that will do the homework, and then those are the ones that see just the decent returns out there, Mark.
Discipline. What fun is that? We want the silver bullet. We want to get rich quick, man. That's what we're all about here on the old network, right? Of course, is the get rich quick silver bullet. Of course, I'm joking. Unfortunately, there isn't one. The data proving that yet again here for 2018. As we keep on rolling, it's time now to dive into a little bit of our tricks of the trade.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, everybody. Welcome to the Tricks of the Trade segment, the portion where we tell you kind of how we do some things here and how it might help you as you're implementing options in your practice. And when we launched this show years ago with our friends over there at the OIC, it was kind of formed and created around one central tenet, one central thesis. And that was, how do you really convey the value of options to a client out there as an RIA, as an asset manager, as an advisor? How do you really boil down the benefits and get people on board who may otherwise be reticent or leery? And over the years, I think we've explored that in a variety of different ways. But here at the end of 2018, it's always a good time to kind of look back on that and explore some of the ways that we do that with success and perhaps not success as well, as you are looking to build out your options practice here. Again, this is a difficult, sometimes a scary question, particularly these times. You have a little bit of volatility in the marketplace. Marketplace may be a little bit top heavy. Clients may already be coming to you a little bit jeery, a little bit concerned about the general state of the marketplace. Now you're adding on the layer of the dreaded D word, aka derivatives, and that may scare them more. They may come to you with a lot of misperceptions about options. They may view them as overly complicated, as perhaps overly complex for their needs. These are things only for big institutions. They're not for me. Or maybe they're a fund manager or a pension plan manager, and they think, oh, these things are risk additive, not risk mitigating. They may have the wrong view there. So there's a lot of things you may confront no matter who you're trying to approach. It could be an SMA with a small retail account. It could be a large fund. It could be a pension. Could be anyone out there trying to learn about, but they're still a little bit leery, a little bit reticent about options. So it's always a good topic to kind of revisit here on the show. Let's go back around the horn. We'll start with you again, John, because I know this is a topic that's near and dear to your heart. You guys are, of course, in the process of doing this right now in Northern Trust as you're kind of building out your options desk and your options offering. You know, Northern Trust has a lot of legacy securities clients, and some of them may indeed be reticent to look at options. And of course, you're also interacting with a lot of big funds and institutions who may, like I said, have some of those same misperceptions about options. So what is it you guys are doing over there to kind of overcome that and really try to convey some of the value of options for your clients?
Yeah, so what we spend a great deal of time on, and kind of at this point in my day-to-day, about 80% of my week is centered around education. And it's talking to family offices, foundations, endowments, and pensions, and even RIAs about the use cases of options, whether that be risk management or opportunistic trading, but all of the different kind of theories and even scenarios of how options can be additive. Whether they're, again, risk reduction strategies or even risk enhancement strategies where they may see fit. It all centers around the theme of education. And so I think the industry, by and large, has come a long way, even for us veterans, in that department of educating investors about the uses of options. But it's something that I think is going to be the catalyst to really get options more into portfolios in the years to come.
And is there a typical approach? I mean, people like to approach it in different ways. Some people will look at the individual client, maybe a large fund or a small fund, and they'll identify maybe a particular need, and say, oh, you really like risk management, so we're going to approach options from that perspective. Is that the kind of the way you approach it as well? You kind of take it from a utility approach. What's the utility of options to you? Or maybe do you try a different way? How do you like to broach the subject with clients?
Yep, that's a great question because the answer is it depends, and it depends on the audience. The how you're talking to, from my standpoint, a lot of our clients are successful and educated in their own right, but they may not be well versed in options, right? So there are conversations I might be talking to a very sophisticated, pension manager, and I'm going to be talking about options and never use the word options. And so, I'll be using, terms such as, protection, speculation, insurance, et cetera, or income, whatever it may be, in kind of tailoring those conversations to the appropriate audience.
And Chris, obviously you guys deal with this a lot at Swan as well. You've built a whole outreach program around the 10th box and trying to tackle this one very difficult prospect. I'm curious for you, what are your thoughts on maybe some of the best approaches? I mean, these could be intimidating topics. You mentioned things like volatility. People get scared. You mentioned things like the Greeks and people's heads explode, so it could be intimidating if you approach it wrong. How do you think, what do you think is one of the best approaches for conveying, the utility of options to a client, whether it be a fund or an institution or an SMA, an individual, without spooking them in the process?
Well, I'm going to go off tangent here and say that, just about everybody except for Matt on this call, was a little bit intimidated the first time they drove a car. So, once you learn how it works, it's not that intimidating, and especially after you have a lot of practice, right? You get into a car, and what does the steering wheel do? The steering wheel tells you the direction of where your car should be going, right? So that's delta. Then you've got then you have the pedals, right? A brake and accelerator. Well, that's what? That's supply and demand. That's the volatility of an option. And then you have these additional dials like gas levels, engine temperature. Well, those are the higher order Greeks that all do what? They all help you assess risk. So every time you're driving a vehicle, a car, you have all these components you have to deal with, and then you have to manage your risk at the same time. And I think option trading, and then we get better, right? Don't we get better and better as we drive more and more, hopefully? That should be the goal. And it's the same thing with options. With more and more practice and the tools out there available, like back testing, what Matt has, just some simple paper trading, keeping it down to one lot so you can really see how all these different dials, the steering wheel and the pedals are all working together. And then once you get that confidence, that's when you can make the next step and put real money towards it.
I like that analogy, the driving of the car analogy, because it's something everyone can usually commiserate with. Who knows in the future with robo-cars coming, maybe that won't be the case anymore. But for the time being, that analogy holds. Matt, same question for you. People are coming to you looking at, back tests and things like that. How do you like to approach it when, people usually come to you, so that maybe kind of helps a little bit. They maybe already have one foot in the pool, so to speak, when they reach out to ORATs. But if you're talking to a general firm, a general fund, and as John alluded to, too, these are people who can often be quite financially sophisticated, and yet when it comes to options, not so much. And so you also have that other dance of you don't want to talk down to them. You don't want to scare them off from that perspective or offend them, but you also want to make sure they understand the topics here, which can be a little bit intimidating sometimes. So how do you handle that delicate dance over there at ORATs, Matt?
Well, I'm going to stay with the car analogy because I love that one. And unfortunately, I learned driving a car with a stick shift, so that even added an extra layer of complexity. So I'm going to say, take out the complexity of it. That's how I'm going to use that analogy that Chris brought up. But, I see, when people come to me or talk to me about options, I think there's just a step-by-step process. And the first step really hasn't been mentioned yet, but the first step I think really is to, for long, short, or just regular investors, to start looking at option information. And the first thing is the VIX that people look at. There are, in my opinion, better things to look at than the VIX, but that's usually a good thing to start looking at. So people start to get a feel for, the VIX goes up when the stocks go down, usually. And, so that's the first step. So what we're trying to do at ORATs is we're attracting firms that don't even trade options yet, but they will use option information to trade their long short or to do whatever else in their economic forecasting. So I think that's the first step, is to start to use option information and start to understand option information. The second step is then to have once you have a feel for it, you might, that's when you want to maybe take a bet, one side or the other. And that's where you start off small in your own personal account. And that's what Cirilli Institute said. Advisors that trade for themselves are much more likely to suggest trading for their clients. So trade for yourself, see how it works. Obviously, keep it really small, like Chris said, one lots. And then, use tools like back testing. You could really learn a lot without, paper trading. Try that. If many brokerages have paper trading, trade for yourself, paper trade, back test. That. And then once you start to do that, then you start to learn, hey, options can really work for me. I don't need to have just a return payoff picture that's just a straight line that's owning long stock. I could protect myself buying a put. I could, if it rallies, I could give away a little of the upside by selling a call. So these are things, I think, the steps in order to get into option trading, and that's what we at ORATs are trying to help certain clients with, is to take those steps and to really understand what they're doing, Mark.
Yeah, there's a lot of different approaches to it. We've been doing the show for quite some time now and talked to a lot of people about how they approach it, talked to a lot of clients, talked to a lot of advisors and funds. And, we kind of boil it down in a couple of very simple, I kind of outlined them a little bit earlier, but people like very, direct, specific advice when they listen to a show like this. So we have some of that for you. For example, a lot of clients come to an asset manager looking for retirement type funds and management of that. So they're very in tune to income and things like dividend yield and things like that. So you have a client who's in tune with that. Options are very well suited to that. There's many ways you can augment or create income streams using options. And again, I encourage you to look through the archives of this program, search for income. A lot of episodes about that in specific, but things like covered calls are a very basic way to get started with that. And of course, a lot of your clients who are long equity already can understand the basic premise of being long equity and getting paid to sell the stock at a certain price. And that's something that is good for you, good for the client, as long as they understand the risk equivalency of to the short put and things like that. It's not something that's overly intimidating to the large number of clients. And also it's attractive. A good approaching point is to say you can, instead of looking for a stock that pays a high dividend, you could create a dividend income stream on any underlying you desire. That's always an attractive way to at least begin the conversation and maybe perk up their ears a little bit when otherwise maybe they'd be a little bit reticent when discussing options. Also, whatever you do, don't mention the dreaded D word. Don't start off with derivatives. There's a reason why we don't call this network the Derivatives Insider, because no one would listen. It's a terrifying word. So stick with options. It's usually better, or even other instruments. You can go other ways than that, but stay away from the dreaded D word. Again, other things, if your clients are concerned, if they're coming to you right now looking at these markets being somewhat lofty, a little bit intimidated, maybe they want to protect themselves, then focus on that element. And of course, there's a lot of ways you can go. Very basic protective puts and put spreads. Of course, look to our archives for those as well. If they get a little bit sophisticated, we've talked about it before on the show. I've often said the holy grail for asset managers and advisors, the holy grail options position is really the collar, which is, of course, provides protection to the downside, the covered call to the upside, combines two positions that asset managers are very well suited to and puts them into one for easy management. You can get a little bit more advanced, like Chris and the folks at Swan like to do. They add the put spread, so the put kicker and things like that. You can do all sorts of fun things with it, play around with the duration, but the general approach of the collar, I think, is something that's well suited to a lot of clients out there. If they're coming to you, if they're a little bit younger, a little bit more aggressive, or they want to manage a larger portfolio, looking for maybe a big fund, looking for more appreciation, then more speculative types of approaches like verticals and things like that are also a good way to go. And of course, you talked about it before, some other basic things, very, very basic approaches you can do with options that are of demonstrable benefit that your clients should understand and most asset managers should understand. Most everyone is familiar with using limit buy and sell orders in stocks. So you can obviously swap those with options. And now you have an income stream on top of working orders. You would already be working in the marketplace. So instead of working to sell the stock with a limit order, you sell a covered call. Now you're getting paid for that risk. And the same thing with the buy order in an underlying. We've all seen working stub orders and limit orders in the equity markets has risk. You should be rewarded for that. And so selling a put instead of that is another way to do that, or a put spread in a more risk mitigated fashion. And the other thing we touched on recently on the show and worth repeating again is, of course, stock substitution, another very basic use case for options that most long equity holders in particular can wrap their heads around and understand. Instead of buying a stock and spending all that money to buy the underlying, or maybe doing it on a 50% margin, now you're saving a lot of capital just by buying a very deep in the money option. And we've discussed ways very recently here on the show to do just that. So check out stock substitution. Those are kind of three very basic approaches that you guys can take when you're talking with your clients. So let's go around the horn really quickly, see if anyone has any final thoughts on this before we move on to some of our other segments. John, this was your idea, so we'll start with you. Any final thoughts, any final takeaways for advisors out there who are approaching either individual clients or large funds in terms of maybe you agree with our thoughts, maybe you disagree with those approaches, maybe you have approaches of your own. Any final takeaways here on how to really broach the subject of options with the advisor and indeed with the client?
Indeed. So I think it's from an alternative approach standpoint, kind of expanding a little bit on what you said as far as using options as a means to reduce the risk in an underlying asset or increase the risk. It is something that we talk about with clients all day, every day. And so one thing that I talk about quite candidly with clients is if you're looking to sell stock and you're patient to do so and you have a limit price in mind, as you eloquently said, Mark, get paid for that. Get paid for that risk by selling a shorter dated covered call as many times as you possibly can to clip those income coupons. Again, you want to get out of the security knowing that you're patient to do so at a specific price. Specifically in single stocks, you can see some really nice single stock volatility within a lot of the names, especially today. And so you could look at some meaningful basis point premium income to be received.
I like that, clipping the income coupon. That's a good way to view it there. Clip that coupon, time and again, week after week, month after month. That's always an attractive thing to a lot of clients. Same thing to you, Matt. Any final thoughts here on this most delicate of dances, but yet a very important one for our audience?
Yeah, I mean, you could learn a lot listening to this. I have adapted my trading from my personal account, listening to Chris at Swan and John. So, with a stock substitution, I went and tested some of those deep calls, and it is those leaps, with about a 85 delta, look pretty nice in the back testing. So I've incorporated that. Trade. I think the advice is try it in your own account with a small amount. And if you're going to be long the market anyway, why not do it with a call that costs $50 than the SPY that costs $250. And then once you have that, I like to look at the environment. Like right now, I don't know. I think that there's going to be a lot of volatility coming, so I'm a little worried about it. So maybe you buy a put against the, when you buy a call, you actually kind of own the stock and a put, so you can, so you have a put with that call. But I'll even buy another put, so I'll be doubly protected in these types of scenarios. And then like Swan does, when it goes down, you could then buy another call. And then you're longer when the market recovers, if it recovers. So I mean, those are some of the things that I'm trying to, when you're learning about some of these strategies that we've talked about here, and you've back tested them. Go in your own account, do a one lot, try it out. That's what I'm doing, Mark.
Same question for you, Chris, as we round it out here. Any final thoughts, takeaways, approaches, advice for the clients out there trying to get at the core mission of this show, which is to really approach options with their clients?
Yeah, I mean, the number one goal for all of us and why everyone listens is what? To learn how to maximize our returns. So options can be a great way to change that distribution of returns, and that's what we do at Swan with our hedged equity program. Unfortunately, a lot of people suffer from what's called prospect theory, where if you have the choice of flipping a coin and winning $100 or zero, and your other choice is taking the $40, most people take that $40 instead of, even though that the expected value is better with the first choice, trying to make the 100 or the zero. And I think that is really when you employ options, whether it's for income producing or hedging out, you're trying to avoid the failure of prospect theory. You're trying to be in the minority and make the right decision based on an expected value that is ultimately, in the end, going to maximize your return.
Look at you, the director of risk, full of quotable moments here on the show today. I like it, full of good analogies. You've been saving up here on the show. I like it. We appreciate it as we keep on rolling into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, that music means it's time to break into the world of options. Maybe some news that you missed but could be relevant to you. Our friends over there, of course, Eric and our friends over there at OIC, traveling hither and yon. Happy to say Eric they have a new leader of that team now over there, which is Paul Finnegan. I know they were without, Eric's been kind of doing double duty over there for a while, the OIC advisor team. Happy to see that they have new staff going on over there. Things really kicking into high gear for them as they're doing even more outreach to the advisor space coming up here in 2019. But big news from our friends at OCC as well. Of course, OCC, the mother company of OIC, the Options Clearing Corp. And it's been rumored, it's been bandied about, it's been prognosticated for pretty much ever since February. And things really took off with a bang in terms of options volume. Would this be the first year for the options market really to hit $5 billion? And the news just broke, I think yesterday morning actually, that yes, it is indeed that year. The OCC set a new record with 5 billion cleared contracts to date in 2018. Actually, 5.01 as of the time of this release, which I believe was yesterday morning. That's, of course, total cleared contracts. OCC clears other stuff than just options. It's mostly options, 99.9% options, but still, there's a little bit of other stuff in there. So if you drill down into listed options, it's 4.91 billion contracts year to date. There was about 10 days left at the time of this writing, so maybe, hopefully, we can hit the 5 billion in actual options contracts as well. The previous record, you got to go back a long time to find the previous year that they set a record in, which was all the way back in 2011, with a record of 4.6 billion total contracts and 4.56 billion options contracts. That shows kind of how the options business and market has kind of plateaued in recent years. It hasn't really set a new record since 2011, which is quite some time. And the ADV, the average daily volume, also new record, 20.7 million contracts, almost 20.8. That's 20.5% higher than the ADV of about 17.2%, which was 17.2 million, which was 2017's level, and nearly 14% higher than that last record back in 2011 of 18.2 million stuff. So interesting stuff here, kind of just a nice note. I know, Matt, you're kind of you the keeper of our data here. You watch a lot of this stuff. Were you kind of wondering if they were going to hit that 5 billion mark? And are you surprised? Are you also surprised? I'm still kind of surprised that the legacy, I guess you can call it the gift of February, has kept on giving throughout 2017. Obviously, we saw other developments that continue to deliver volatility, continue to drive volume. We all know volatility equates to volume, usually in the options market. So we have seen a lot of the former that generated a lot of the latter. But are you surprised that it maintained throughout the year and we managed to hit the 5 billion level this year, Matt?
I like our friend Henry Schwartz thought we should go find the person that actually traded the 5 billion
yes,
option
yes.
and give them a gift. So
the Flowmaster has been watching this for some time. It's kind of his deal, yeah.
I think that February definitely helped the volume figures, and it has continued. I'm being an ex-market maker and running a firm of market makers myself. I'm always a little bit skittish and skeptical. I don't see enough worry out there. So I think that in a market and like we're in right now, it's polarized, just like I guess the world economies and the world political economies are polarized. But there's I don't see enough worry out there. So I think there's going to be another shoe to drop. I think there's going to be more volatility out there. I think there's going to be more volume. People still have some risky positions out there. Naked selling puts. So I'm a little worried. I don't think people are worried enough, but I think that this market has a lot of disagreement out there. Some people are buying the dips, and other people are saying this can't continue. Things in Washington, et cetera, are going to continue to light up the options market, I think, into 2019, Mark.
Yeah, it has been interesting to watch. I know, John, this has been an interesting topic, I think, in the institutional space as well. Matt, you mentioned our buddy Henry there. He's been keeping a good eye on this. But is this something that's of interest to a lot of your institutional clients, or maybe just in general, are they kind of feeling the buzz of all this volume, and maybe that's tangentially leading to them being more intrigued about options going forward into 2019, John?
Yep, I think, more so the latter. So it's more generally, a nice talking point. So we collect a lot of data internally as well. And so seeing volumes increase, notional values traded, and then, options volume kind of increase month over month, and then, quarter over quarter is certainly something that we've seen as well. But, I agree with Matt that while we're seeing volume increase, I'm of the opinion that I think volatility is going to stay, from higher than the median levels that it's seen, kind of above the low 20 range in VIX. Not that, VIX is a good, snapshot indicator. I know a lot of different investors look at other metrics as well, but VIX being kind of a nice 101 way to view into volatility. But we've seen the gyrations that we've seen from the percentage movements that we've seen in the S&P have not necessarily inspired kind of the flush that I think a lot of the professionals are looking to see, Mark.
Yeah, you're right. It has been fascinating to watch. You mentioned data. We'll hit on a little bit of data here, and more kind of recently breaking data, kind of just coming into us here on the show before showtime. This came out of Wells Fargo Gallup poll they commissioned, asking investors about a variety of topics. They polled. What did they do? They polled here. A Gallup poll for 1,022 adults with 10,000 or more invested in stocks, bonds, or mutual funds. 67% non-retirees, 33% retirees. Interesting mix. Of the total respondents, they had about 40% with annual incomes of less than 90,000. 61% reported 90,000 or more. So there you go. That's who they're talking to. And they asked them a bunch of questions. First off, they asked them about the Fed. And they said, do they think the Fed should keep raising rates? And they said overwhelmingly no. 61% of investors saying no. That didn't surprise me. I thought, well, when do investors ever say Fed should raise rates? But this actually is up from a level of 46% in the same poll back in May. So they were, at least by a slight majority, leaning towards the yes back then. So this is a little bit more savvy audience they're talking to here. They also said the rate hike would be bad for the economy, compared to 16% who said a rate hike would be beneficial. 37% saying not much of a difference, so they're kind of agnostic there. Also, they said only 16% of the people they surveyed said they were very concerned about the recent sharp volatility in the marketplace, which is kind of interesting. A strong 68% purported to be comfortable riding out a 500-point drop in the stock market in a single day, and therefore maintaining their long equity positions. So interestingly, they're not spooked by the apparent. Now, they don't ask, what about subsequent 500-point sell-off days, which we have seen of late. Maybe a few of those might spook them, but I guess one. They're comfortable riding out one. But this is kind of what's surprising about these numbers. Again, that's why people say there's lies, damn lies, and statistics. These may be contrary data points. As to their appetite for risk to generate higher returns, 52% had little or none, while 48% would be willing to take a fair amount of risk or a lot. Of the 47% of investors who expected to live past 86, 51% said they'd be inclined to take more risk. So they don't have they had 52% say they have little or no risk tolerance, yet they're willing to sit out a 500-point drop in the market. But that means you have a pretty decent risk tolerance, at least to me, anecdotally. Let's see, in talking about the Fed, the 53% of them had faith in the Fed, 47%. I think that breaks down more along political lines. But interesting stuff here. People want the Fed to stop. They're more concerned actually about inflation, which is kind of interesting. Again, speaking to maybe a little bit more of a savvy group, they found that inflation could be an even bigger stressor for investors than rate hikes. 70% of respondents expressed concern inflation could go a lot higher versus 30% who were more worried that rates could do so, which is also kind of interesting, maybe contrary. If you're worried about inflation, maybe you want the Fed to rise because that's ostensibly the reason that they're doing that, right? So some interesting, somewhat, shall we say, contrary data points. I thought was really interesting about the volatility stuff here. I don't know, Chris, any thoughts on this? Obviously, as the director of risk, you're out there, managing people's expectations. One of the core tenets of what you guys do at Swan is, to stay invested even through these 500-point sell-offs and beyond. Any thoughts about this data, people's lack of risk appetite, but yet still being willing to shoulder a 500-point sell-off in the marketplace, sir?
Well, it's confidence in your portfolio. If you're employing hedged equity techniques, then it's designed to not shake you out, because there's a tendency to do what? We sell at the worst times and we buy at the worst times. So, there's I'm going to throw another one out there, the Pareto principle, right? 20%, 80% of your profits come from the best 20% of your trades, in the trading world. Well, if you're a technician or market technician, well, you want to ride that 2/3 of the meaty train, right? You're not going to pick the bottom. You're not going to pick the top if you're a market technician. And unfortunately, in the retail world, we have a tendency to pick the bottom, but we're selling it. We have a tendency to pick the top, but we're buying it. So again, it goes back to what? It goes back to options and trying to keep you from making poor decisions. To keep you in the game when you feel you shouldn't be. And vice versa.
John, any thoughts on this and this data coming out here saying investors, they don't have much risk tolerance, but they'll also sit through a pretty big sell-off in the marketplace, and also they don't want any more Fed rate hikes. Any thoughts on this? Are you hearing similar stuff from the clients you're engaging with over there at Northern Trust?
The point I'd add is while I think clients like to kind of, to Chris's point, you're comfortable and confident within your portfolio. What does tend to happen is and we saw this a lot in first quarter, particularly in late in 17, where the market was at higher valuations. And so while I'm comfortable with my portfolio, I still value it the way it is. It might make sense for me to put some protection strategies in place, kind of regardless of the expense. So it would be more of a prudent way to put some hedges on in an opportunistic fashion in the event that stomaching a 500 point decline.
All right. We'd like to make sure you guys get a little time on the show as well. So without further ado, we're going to open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. We got a lot of questions, not a lot of time to get to all of them, so we'll try to squeeze in a few here. A couple here. First off, from Liam. Liam Hardy wants to know what our thoughts are on the option sellers hedge fund blowing out from the recent nat gas spike. Is this just another example of getting greedy, selling options without appropriate risk management? A lot of you probably saw this. The Journal ran with it. This gets a little bit to the sensationalistic nature of the options market whenever there is a large loss due to poor risk management, which is what this was. Then it gets exacerbated and played out in places like the Journal. They like to hit on those elements, and unfortunately, clients did lose their money, and that's never a good state of affairs. If people listen to this show, if they listen to things where we talk about on the show like this, where they implement proper mismanagement, they're not naked short tons of units to the upside or the downside. That was the case here. This person was extremely leveraged short a lot of net units, which can be a dangerous thing, as we saw, and we saw pretty much a black swan movement to the upside in natural gas, and that pretty much wiped out this fund that was pretty much naked selling a lot of calls to the upside. And we talked about that before. Calls is analogous to selling short, listeners. There's no limit to the upside, to how much you can lose. And they unfortunately experienced that. So that's why we talk all the time about using spreads and proper risk management, proper risk mitigation. If that was the case, then this fund would have lost money, but it certainly wouldn't have gone out of business, and the clients would still be living to fight another day. So that's why we always talk about things. It gets a little sensationalized sometimes in the broad financial media, but that's, I think, the main takeaway from that. That is an example of, unfortunately, yes, getting a little bit overly fascinated. The name of the fund was Option Seller, so they're gonna squeeze that premium as much as they can, and unfortunately, they squeezed it until it popped, and it popped in the wrong way. Let's see. Follow-up question comes from Neville. Neville T. Let's end on a happier one. Let's go with this one. Neville T. wants to know, what are our predictions for the options market for 2019? Well, this opens up the door to a lot of fun prognostication. We can take this a lot of different ways. We can go broad volume. Will it be a similar year to 2018 from a volume perspective? Maybe you have some individual highlights. Maybe a volatility prediction. I'll let you guys have dealer's choice. You can run with this however you like. I'm going to spin the wheel here. Let's see. We're going to land. Let's land on the director of risk first. Let's put him in the hot seat, Mr. Director of Risk. For our listener Neville T, you have any hot predictions for the options market for 2019, sir?
I think you're going to see other components that make up volatility move very quickly. Case in point with the skew. That's right. I said skew. It was very, very steep for many, many years. That's all we ever talked about because that was the natural trade, right? Sell put spread, buy call spread. And what we've seen over the last month or so is the complete opposite, where people are now selling call spread, buying put spread, right? They're just rolling the structure down because that's what the market has been doing. And, the sell-off that we've been experiencing, even though they're large, a lot of people are getting somewhat nervous. It's still kind of been structural. I mean, it hasn't been this February downdraft or what we had in August of 2015, where it was very violent and vicious, and then we recovered very quickly. This almost feels very structural. This is what a bear market is, and this is one of the reasons why you're not seeing the VIX explode. And there's, how come the VIX isn't 30, 35, 40? Well, because the realized volatility in the way the market's moving right now is just a nice stair step down. But what we're going to see the changes are very quickly are in other risk metrics like skew. I was very shocked how it went from so steep to basically 0 percentile now. So I think that those components are going to move a lot quicker in the future, and the VIX is actually going to be a lot more stable product.
Interesting. I think a lot of people would probably be welcome to see that in the marketplace in 2019. John, same question for you. You have any predictions for our friend Neville T? Could be volatility, could be volume-based, could be maybe a specific underlying you're watching. You have some thoughts on that? Whatever you got for our friend here, sir, have at it.
Sure. Yeah. So kind of an extension of what I said earlier. I think that we're going to see, the VIX and VIX futures kind of stay in an above average range going into 2019 for kind of the obvious reasons. Things coming out of Washington, looking at the end of a business cycle, perhaps a recession going forward. You have the Fed raising rates. And so I only think that's going to drive up option volumes. And so I'm looking forward to that, Mark.
Two prognostications here about the VIX. Matt, should we make it 3 for 3? You have something else up your sleeve?
Well, I have a pretty good indicator, Mark. We recently purchased a house, so I'm sure we'll see the real estate market tank. So, that's what I'm looking forward to in 2019. But, all joking aside, it still looks like the market's going to be pretty volatile according to all our numbers. I've figured out that ORATs and our technicals are a little more shorter term, and Chris is a little bit better longer term. So I'm not going to make any more long term bets with Chris. So I'm going to leave it to his prognostications.
All right, everybody. That music, unfortunately, means we've come to the end. Another fun journey through the world of advisors' options. We started off looking back a little bit. We ended looking forward. So a nice cyclical coming around to full circle here on the old show. But before we go, I'm going to go back around the horn, check in with each of our cohorts, see what they have cooking that may interest you coming up here in the new year. Let's go back around the opposite way. Let's start back with John again. John, if people are intrigued, they want to learn more about what Northern Trust has going on with the options desk, where should they go? What should they do, sir?
Thanks, Mark. Yep. So any needs for both trading and prime services, feel free to reach out to me, John_Cherry at ntrs.com. And I look forward to it, Mark. Thank you. Happy holidays.
Yes, happy holidays to you as well. Well, let's go back up to the hinterlands, the frozen north of New Hampshire. Matt, we heard a lot about earnings analysis. We heard a lot about models. We heard a lot about back testing. You guys do a lot of stuff over there at ORATS. If people want to learn more, where should they go? What should they do, sir?
Come on over to orats.com. We're actually going to launch a website, our new website coming up. And, we're talking a lot more about technical indicators based on options. We're talking about back testing based on technical indicators. Backtesting in general, tail hedging, protection, income producing, all that type of stuff, scanning, implementation of option strategies. So come on over to Option Rats on Twitter, or Matt at orats.com on the old email, Mark.
There you go. ORATS.com, ORATS.com is the place to go, or give them a follow at Option Rats. You can't forget that handle. It's memorable. So give him a follow. Get all that good data and back testing that he's tweeting out all the time there. You can check it out there in between our episodes of the show. And last but not least, Mr. Chris, if people want to learn more about what the Director of Risk is up to, or what you folks over there at Swan have going on, maybe on the 10th box, maybe on some of your cool newsletter and white papers you got going on, where should they go? What should they do, sir?
Yeah, so speaking of websites, we recently revamped ours to cater more towards whether you're an individual investor, financial professional, or institution. So hopefully it'll give you a more customized experience. We're wrapping up the year here, and we'll have a new schedule coming out on our seminars, the 10th box, like you mentioned. And, of course, we're going to continue with our blog posts and all the great research papers that we've been putting out.
It's a theme. Everyone's doing a new website. We're, in fact, in the process of building a new theoptionsinsider.com as we speak as well. So everyone's got a new web presence coming, or maybe already here for 2019. I'm looking at it right now. You can check out the brand new Swan website at swanglobalinvestments.com. Click on individual investor, professional institution, and then get the ball rolling with all that good content they have on the blog. And of course, you can stream the show there as well. So spoiler alert, plug for that. Check out the show there as well if you want to. A lot of good stuff over there from the team at Swan. And of course, they couldn't join us today, but I want to also send out a shout out to our friends over there at the OIC, Eric and Paul, now on the team over there. Optionseducation.org is the place to go. You'll see that tab on the right-hand side. I believe it's still on the right. They changed the site up a little bit recently. You'll see it's called Advisors. Click on that, and you have to log in there. Then you get access to all the great data and study and research they do over there. So if you're listening to this show, you heard our topic today about how to broach options with your clients. Maybe you want a little bit of data to back that up. That's the place to go. There are a lot of great studies and research for you. Optionseducation.org to learn more. And on behalf of Eric, who couldn't join us today, and John, and Matt, and Chris, a.k.a. the Director of Risk, and indeed myself, I thank all of you out there for downloading, streaming, subscribing, sending in questions, listening live, all the fun stuff you guys do. Keep it coming, and we're looking forward to many more fun episodes of The Advisor's Option coming at you in 2019.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. The Advisor's Option is also brought to you by Northern Trust Capital Markets, offering a unique blend of transparent trading, quality execution, and smart liquidity solutions across institutional brokerage, transition management, securities lending, and foreign exchange. Northern Trust's options offering includes quiet access to non-traditional pockets of liquidity, with hands-on support from experienced traders to customize your trading strategy, combined with the peace of mind that comes with trading through a stable and globally respected firm. To learn more, contact John Cherry at John_Cherry, spelled like the fruit, at ntrs.com, or visit northerntrust.com/capital markets.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.